In prior videos, I walked you through the four-step process of preparing balance sheet reconciliations for a relatively easy balance sheet reconciliation and one reconciliation where we had to create our own subledger report. In this video, we'll prepare an account reconciliation that is a difficult one because it involves deferred revenue. Just as a reminder, this is the four-step process for preparing balance sheet reconciliations. Please see one of the prior videos for a more in-depth review. Let's review first what deferred revenue is. Deferred revenue or unearned revenue occurs when the customer was invoiced for a service or product, but the delivery of the service or product happens at a future point in time. That is why it is considered a liability on the company's balance sheet for the portion of the invoice that has not yet been delivered. Once the product or service has been delivered, it is moved from the deferred revenue liability account on the balance sheet to revenue accounts on the income statement because one, it's no longer a liability to the customer, and two, the income has been earned. The rules for revenue recognition are complex and can differ by industry, type of product, subscription model, and future promises made to the customers. My revenue recognition experience comes primarily from the hardware and software industry, where RevRec, which is what revenue recognition is typically abbreviated to, is a huge topic. In one company, the complicated issue was separating hardware and software, when part of the software revenue was earned over time, and hardware and software were not typically sold separately. In another company, the revenue consisted of subscription revenue for both external and intercompany international companies, where part of the revenue was earned at the time of installation and the remainder over time, with different percentages for the install portion depending on the product. An additional complication was currency adjustments for intercompany sales and costs. However, our main focus for this video isn't the complex structure of RevRec arrangements, but the focus is on how to prepare the balance sheet reconciliation. I recommend, though, that you become familiar with what your company's rules are for revenue recognition. There should be a white paper, meaning a document that details the company's products, assumptions, and the process for revenue recognition. Typically, the auditors will want to know about this information as well. So your company should have it. If it doesn't exist, it's a good idea to document the process and assumptions. As with all reconciliations, the process starts with the general ledger account. Run a query in your accounting system for the GL report or ask someone on your team for the query if you're not sure where to find it. The activity in this account depends on the process your company uses to record revenue deferrals. Some companies use what I've labeled here as RevRec Process 1 to record all invoices first as revenue on the income statement because management wants to be able to see the total sales amount invoiced for the month. It's also a nice double check to be able to tie out the revenue on the income statement to the invoice register at month end. Then at month end, the accountant or the system, if your accounting system has revenue recognition functionality, prepares the journal entry to move the revenue that has not yet been earned to the balance sheet, meaning debit to deferred revenue to the deferred revenue account on the income statement and credit to the deferred revenue liability account on the balance sheet. So in this example here, we have a 12-month subscription invoice that we billed to a customer for on October 1. The company's white paper states that the invoice is spread evenly over the month of the subscription. So under process 1, we first record a debit to accounts receivable and a credit to sales revenue for $1,200 when the customer is invoiced. Then we determine at month end how much of this invoice has not yet been earned. $1,200 divided by 12 months equals $100 per month, and it means that the company earned $100 for the month of October and $1,100 is deferred. That means that we debit a sales revenue account. I use the sales revenue deferred account and credit deferred revenue liability for $1,100. Now that also means that you have to keep track of this amount over the next 11 months and recognize $100 each month. I bet you can already tell that this can easily get complicated as more invoices are amortized over the recognition periods. Other companies book all revenue to the deferred revenue liability account on the balance sheet first. I've labeled that here as process 2, and then at month end, the accountant or the system prepares a journal entry to move only the revenue that has been earned that month to the income statement. So under process 2, we first record a debit to accounts receivable and a credit to the deferred revenue liability account for $1,200. Then we determine at month end how much of this invoice has been earned. $1,200 divided by 12 equals $100 per month. And it means that the company earned $100 for the month of October and $1,100 is deferred. That means that we debit the deferred revenue liability account and credit the sales revenue account for $100. So the various GL activity you would see in the deferred revenue liability account depends on whether you're using process 1, where you book all revenue to the income statement first and then move the unearned portion to the deferred revenue liability account, or process 2, where you book all revenue to the deferred revenue liability account first and then book the earned portion to the income statement. However, the net amount of all transactions should be $1,100 credit to the deferred revenue liability account, regardless of the process used. So how exactly do you keep track of all revenue recognition transactions? Sometimes your company's ERP has been configured to track revenue recognition, and some companies manage this manually. There comes a point, though, where you have to consider automating RevRec because it may be inefficient to do so manually. I've created a revenue recognition schedule here for the month of October. The schedule, when manually prepared, should include all invoices for the month, and there should be some reference that you've tied it out to the invoice register. Then you prepare what is essentially an amortization schedule of when each invoice will be recognized as revenue. This is an example of 6 invoices for a 6-month subscription product. The sample company has a policy of using 180 days for each 6-month product to calculate the deferrals and uses an equal amount for each month, except for the first month and the last month, which are prorated. First, we have invoice 101 with invoice date 10/1 and an amount of $2,152 and a quantity of 1. The term for the subscription is 180 days. And since this is a full month for October, we equally spread the revenue across October, November, December, January, February, and March. Your company could have a different policy. For instance, it could say that you recognize the full amount for October if the sale was in the first half of the month, and only half for October if the sale was in the second half of the month. There are a lot of variations to RevRec policies, so be sure that you understand your company's policy. But back to our example for invoice 101, we're going to recognize $358.67 in October and for the 5-month thereafter. For invoice 102 on 10/7 for $2,152 and quantity 1, we're going to recognize $298.89 for October for the time from 10/7 to 10/31. That means that the amount that is deferred is at $1,853.11 for future month. We have 4 more invoices, each for a 6-month subscription product in varying quantities. The total for these 6 invoices shows us that the revenue earned for the month of October is $1,769.42, and the revenue deferred of $39,118.58. That means that our revenue recognition entry for October should be under process 1, where we booked all revenue to the income statement, a debit to sales revenue deferred on the income statement for $39,118.58, and a credit to deferred revenue liability on the balance sheet for $39,118.58. This is what you should be seeing in your GL detail report. Debits to accounts receivable for $40,888 and credit to sales revenue for $40,888, and then the adjustment for $39,118.58 as a debit to sales revenue deferred and a credit to deferred revenue liability. What happens when we add another month to our schedule? For November, we had a total invoice amount of $77,472, and we calculated that we would recognize $6,690.20 for November for the November invoices and defer $70,781.80 to future months. But hold on a second. Now that we reach November, we also have to recognize the October invoices that we deferred to November for $6,814.67. You can probably tell that this gets really confusing really quickly when you have multiple time periods where you're deferring revenue for perhaps 1 or 2 years. So what is typically used in revenue recognition is a triangle report, or sometimes also called lag report. This lag report includes only 2 months, but it is very helpful for understanding the activity in the deferred revenue liability account. This report tells me that for the month of December and all subsequent months, I have deferrals of $103,085.72. This amount should be in the deferred revenue liability account at the end of November, provided that all adjusting entries were properly booked in November, and it represents the liability to the customers for services that have not yet been delivered as of November 30th, 2024. So this is our general ledger report for November. It shows the October deferrals for November 2024 to April 25 on the first line for $39,118.58. Then on the second line in November, we are now releasing part of the October accrual that we had recorded for November 2024 for $6,814.67. And on the third line, we're recording the deferrals for the November invoices of $70,781.80, which are for December 2024 to May 2025. This is a trial balance report for our sample company as of November 2024. It also shows $103,085.72 for the deferred revenue liability account. So now we can feel pretty good about having the right general ledger report, because that report has the same ending balance that we see here on the trial balance report. And we can now move on to getting the rest of our reports that are needed to prepare the account reconciliation for this account. For the revenue recognition subledger, we will use the lag report. If you're using a system to calculate and journalize your deferrals, be sure that you agree with the calculations. I've seen new products being set up incorrectly in the system, and the system will consequently calculate the incorrect amounts. It's not just how the system is set up. Sometimes sales team members make a mistake and the start and end date of subscriptions is entered incorrectly. How do you double check? I found it helpful to have an Excel schedule that replicates the calculation sort of as a double check. Yes, it is more work, but I've seen time and time again that the system did not calculate the amount correctly, either because of incorrect setup for a product, sales staff error, or setup of a deferral schedule. There are a lot of opportunities to make mistakes, and a double check is better than finding mistakes way later and having to make large adjustments. In addition, an Excel schedule that double checks the system calculations can also be the proof for the auditors when they ask, how can you be sure that the system calculated the correct amount? That brings us to step 2 of the 4-step process, which is reconcile the account. That means that you compare the ending GL balance from the GL detail report to the subledger report. One common mistake is to want to compare the total of the lag report to the GL. So be careful that you look at the correct months on your lag report and only pick the month that are still open. In our case, December 2024 to May 2025. And we're now ready to move on to step 3 of preparing the reconciliation. Step 3 now consists of preparing the reconciliation by updating the cover page for the date in the header, the general ledger balance, and the subledger balance. Tab A is updated by copying and pasting the new general ledger detail, and tab B is updated with the subledger report. Be sure to double check that there is no difference between the GL and the subledger. Enter any notes if applicable. This video has been primarily about deferred revenue. However, the deferred cost process follows a very similar path, which consists of preparing an amortization schedule for the deferred cost. The final step is to look over the details of the reconciliation one more time and then sign off on it at the top of the reconciliation cover page. Add any notes related to the deferred revenue account reconciliation, like for instance, if invoices were processed incorrectly by the system. Both the preparer and the reviewers need to sign off as well and also document the completion of the reconciliation on the account reconciliation tracker. Revenue recognition is often a very material aspect of the company's month close. Be sure that you've documented all required steps as stated by your internal and SOX controls. That's it for this step-by-step video on preparing an account reconciliation for the deferred revenue liability account. Watch out for future videos about balance sheet account reconciliations for intercompany accounts and fixed assets.